mathematical concept, and we're going to really look at it from a more simplistic view. So the idea is that I want to highlight a general principle of volatility and then talk about how we want to look at it from a rigorous but non-mathematical approach to the subject of volatility targeting. If you have multiple assets in your portfolio, then your portfolio variance is going to be given by something like this. Let's say the variance of the portfolio, and say the portfolio is comprised of 1/3 in BTC and 1/3 of ETH and 1/3 of SOL, then the variance of the portfolio is not equal to the variance of the sum of the components. Component, let's call that component I. Right, so the sum of the parts is not the whole. And this is a very simple explanation. Of course, there is a way to mathematically define this, and for that we need a covariance matrix. So that this be a covariance matrix, and here we will have, say, P number of assets, or in our case we have these 3 assets. So we have this, so let's call this B, E, and S. Then this is the covariance of B and B. On the diagonals we have this, and the covariance of something with itself is just the variance of that. And here we have on the off diagonals the cross covariances. So we have B and E, and this is going to be a symmetric matrix. So you can assume that here we have a symmetric matrix, right? And the variance of the entire portfolio will be given by this form over here. This is a matrix equation. For those of you who are unfamiliar with matrices, the entire point, you just have to understand that the variance of the portfolio has to account for this off diagonals, which are a result of the correlations that occur, or the interdependencies of these currencies that are not perfectly correlated to another. Because trading BTC and trading ETH are not the same thing, but they are also not totally different things, right? We have some correlations between equity markets and cryptocurrency markets. We also have some correlations within the cryptocurrency market. We have BTC and ETH correlations, and we have these intricate relationships because markets are not standalone and depend on complex dynamics that results in returns being non-independent. So in order to assess the variance of the entire portfolio, or rather, if you are interested in the standard deviation of the portfolio, which is also known as the volatility of the portfolio. So the volatility of portfolio, you have to take into account cross dependencies or correlations in asset returns. And in general, the issue is that this is a function of time, and so is this a function of time, and the correlations are dynamic in nature. And trying to come up with a good model of this is already a huge problem in itself, and there are entire research papers on how to estimate the covariance matrix in a manner that is useful for portfolio management. Now, in our case, what we are going to do is we're going to use a very simple heuristic, and that is the fact that volatility clusters. What we mean by that? It means that there tends to be high levels of volatility clustering together with other high levels of volatility and low levels of volatility happening with low levels of volatility. So when you look at volatility data, or in general, the way of saying this is when you see a significant or high levels of positive returns or high level of negative returns, when you see big shocks in the market, these shocks tend to result in further shocks in the market that results in high levels of market movements. Whereas on the other hand, if nothing is happening in the market, the volatility is low, then it is also likely that there will be very low levels of activity in the market. And if you look at, say, the return square or the moment of returns across time, you're going to see something like there is low levels of volatility, then there is some shock, and then the volatility remains elevated for a while, and maybe it decays, and there are high levels of volatility, and these levels of volatility that is high tends to be sustained for some period of time, and we call this clustering of volatility. So what does this mean? We use two empirical facts about the market. Number one, if volatility clusters, then we can say that historical volatility is a reasonable estimate or is a reasonable proxy for future volatility. And since future volatility requires this complex dynamics that also involve dynamic correlations, since the historical volatility is a good proxy for future volatility, then we say that we can just use empirical or realized or historical volatility as a proxy or estimate for this portfolio, or we can say it is basically an integral of all of the effects of the complex relationships that are occurring in our portfolio. So instead of trying to figure out what is going on inside individually, we just say, let's treat the entire thing as one object. We treat it as a black box and we see what is the actual realized volatility. And we say, okay, since this is the realized volatility, we can perhaps expect something similar going forward. Then we don't even have to figure out what is going on inside these correlations if we can treat the final output as an integral or the summation of all of these small effects that are happening implicitly. So with these two facts, this results in the motivation for volatility targeting. So what is volatility targeting? That is, the portfolio manager decides a level of risk that we want to expose ourselves to. So for example, we have some sigma for the portfolio, and let's let this be an annualized term. So say we are interested in having a portfolio volatility of 30% annualized. Then what we're going to do is we're going to trade our portfolio signals as it is, and maybe our portfolio makes money sometimes and it loses, and let's say the portfolio starts something like that, and this is, say, our portfolio in time. And here we must have used some level of leverage or some level of position scaling in order to obtain the volatility. So here we must have obtained some volatility, and we then compare this realized volatility to our volatility target. And we say that if the amount of realized volatility is lower, let's say if realized risk is lower than target, then we simply say we need to increase the scaling for our positions. And if the realized risk is greater than our target volatility, then we simply need to decrease the scaling. So as a function of time, this entire thing is going to change, right? The risk of our portfolio is going to change with time, and we just keep track of that and make sure that our scaling is adjusted to make sure that anything that is changing is being reacted to. So that is the simple idea. And how are we going to measure this? We need to keep track of two items. We need to keep track of, number one, the scaling of our positions. And number two, we need to keep track of the volatility of realized returns. And we're going to keep track of these two variables using an online estimate of our volatility and our strategy scalars, right? We're going to smooth them to remove or to reduce the level of noise in our estimates. For instance, we can say that the volatility of portfolio, we're going to smooth this, and we're going to assign 1 minus lambda to our previous estimate of volatility, and perhaps we use some new data points that have just arrived. So we're going to use this as our estimate of volatility. So this is the volatility that we obtained from our positions today, and this is our previous estimate of volatility, and then this is our estimate of volatility going forward in time, and then we're going to adjust our positions based on this rule. And one additional point, we're going to assume that in order to convert between the portfolio from the annualized figure to the daily figure, we're going to assume this relationship, that the variance of the portfolio annualized is given by the sum across each of the trading days. And then we assume they are identically and independently distributed, then we can give this relation. So sigma square is equals to sigma square portfolio over 365, and to take the volatility, we just square root this. And on the right hand side, we have the annualized volatility over square root of 365. Now in general, this is just going to be the number of trading periods. So if you have watched my previous lectures before and we talk about the total number of trading periods when we're looking at daily data, we use 252 or 253. This is suitable for equity markets. This is the number of trading periods, roughly speaking, but in cryptocurrency markets, we would have to use 365 since we have weekend trading and trading on the holidays.